Hi there, it's Dan Kurz, DK Analytics. I'm coming back to you from Southwest Florida after a somewhat lengthy stay in Switzerland. It is Saturday, August 31st, and this video, the topic or the theme of this video is coming unglued with ever greater speed. Before I get into that topic, that theme, let me review, as I traditionally do, some valuation metrics, starting with the US dollar. The trade weighted value of the dollar stood at 92.10, again hanging high, even gaining a bit of strength on the back of weak emerging nation currencies, and especially on the back of pronouncements made by developed nation central bankers in terms of their intentions to further debase their currencies. But as I've long maintained, I think this is not a sustainable situation for anybody. But the biggest surprise is going to be, in my opinion, when America opens up the monetary debasement floodgates. And that, combined with America's huge annual funding requirements to cover its gaping trade deficit and its net debtor nation status, are going to have dollars come home. But I'll get into all that. In any event, I think it remains a valuation at risk, the US dollar versus a basket of leading foreign currencies. The 10-year Treasury has been in an extreme bull market, together with government bonds and even corporate bonds around the world. Its yield is all the way down to 1.5%. I think on the one hand, it reflects apt concern and commitment, or conviction rather, that the world is going into a recession. On the other hand, I think investors in these bonds are seeking safe havens are utterly mistaken, given the currency debasement, which is in the offing on the one hand, and the extremely high debt levels on the other. So you've got both solvency or insolvency concerns and or monetary inflation risks. I'll get into that. And that doesn't just go for the dollar, but around the world. So I think the bubble valuations in bonds are epic. The 10-year Treasury going up drives the yield down, underpins at a net present value basis the Standard & Poor's 500. But again, there's a dichotomy here. If investors are running for the recession protection hills in bonds, why is the S&P 500 still near all-time highs, 29.26 to close on Friday? I don't have a good explanation for it, because yes, discounting produces more attractive net present value, but not if those earnings and residuals are going to fall off a cliff, and also not if the current bull market in bonds, this bubble, is totally unsustainable and irrational if one considers it in a broader arena, as I've just said, we'll get into in this video. Oil, again, trading in a pretty tight channel between West Texas Intermediate between 54 and 60. It's a tug of war between declining traditional fields in terms of oil output, offset by a surge in fracking-based oil, which I don't think is going to be sustainable. The industry as a whole is massively cash flow negative, free cash flow negative. It's been financed courtesy of no yields, yield starvation, financial repression, which I'll get into. But the long and short of it is, oil is extremely necessary commodity. It's the most important other than water. And I think supply is going to tighten to a degree that will offset the demand weakness associated with a weakening global economy. Staying in the real asset world, gold and silver, both in US dollar terms, have resumed bull markets. You'll recall that, or you probably know that gold and silver have been in bull markets in virtually all the other currencies of the world. which have in turn been weak against the dollar. But now gold is rising in dollar terms, even as the dollar maintains its strength or slightly expands it. And I think there's going to be a lot more of that to come when the dollar finally turns. Gold and silver, gold at 1520, again over the much watched 1360 or so mark, and to continue to take out so-called technical support levels. That is to the upside for the benefit of bullish stance, and the same goes with silver, punching through 30 and 60-day moving averages. Both these metals look primed for a sustained upside move given what's on offer, which I relate back to my topic, coming unglued with record speed. These are the true safe havens, and certainly not government bonds. Silver is gaining on gold. It closed at 1834. The silver to gold ratio has fallen from the mid 90s to the high 80s, and I think that too is a preview of coming attractions. Silver is much more difficult to get above ground, given that a lot of it is scattered in junkyards. Gold has been hoarded. Let me now turn to the topic that I'm going to attempt to discuss here at hand, and that is, in my opinion, no matter where one looks, virtually everything political, social, economic, and financial appears to be going mad. Yet too many valuations, especially in global bonds and US stocks and in wide swaths of real estate, still suggest blue skies forever kind of a scenario. Actually, with some 17 trillion of government and even some corporate bonds trading at negative nominal yields, it would be more accurate to state that the world has gone not just mad, but utterly mad, especially when considering unparalleled insolvency and monetary inflation risks. The two, as you know, are tied at the hip, and they both spell loss of capital, loss of purchasing power, of very substantial portions for those bondholders that got in at lofty levels. Before I take you through a hit parade of what I call insanity, allow me a political observation or two concerning recent events, which should also make you ultimately wonder, as representative government and the rule of law are setting suns, as in our star, how safe your assets will be from even more overt confiscation than the current redistributionism and the past bailout cronyism, which is surely to repeat one way or another, be it via even more money printing or through unconstitutional wealth taxation in the US, or whatever our increasingly despotic ruling class deems appropriate for the unwashed masses. In the UK, new Prime Minister Boris Johnson, who was supposed to represent the British people and the will of the British people, appears to be busy following in the footsteps of his predecessor, May, in terms of keeping Brexit from happening. At least that's what it smells like to me. Given his insistence last month on rewriting the agreement with the EU bureaucrats, yet still reaching for the October 31st Brexit deadline, and now suspending the British Parliament until after the EU withdrawal deadline. Trick or treat, Mr. Johnson, on October 31st, quite the fitting day or date. How much hanky-panky, I ask myself, or sleight of hand on Brexit has the British citizenry that voted for it had to endure, only to find one excuse or another as to why their country can't get its sovereignty back from Brussels? Inevitably, Elected politicians are bought off. That's my strong sense of what's going on. They are either pressured or blackmailed or threatened or made rich, and perhaps in intense fashion, by the all-powerful bureaucrats, also known as the deep state, that run virtually everything today, which is precisely why we don't have representative government anymore. They are unelected bureaucrats. Of course, all the money printing since 1971 has been the mother's milk that has allowed OECD governments to turn into modern day monsters in the first place. What happened to representative government in the UK and in European nations? And by extension, what happened to national sovereignty and solvency? Shifting to the US, where well over 90% of our de facto laws, that is, regulations with stout penalty and even incarceration teeth, emanate unconstitutionally from the executive branch's 2 million strong unelected bureaucracy, not from Congress. Once again, what happened to representative government? Staying here in the US, after Chief Law Enforcement Officer slash FBI head Comey, that is the former FBI head Comey, in the summer of 2016, read a litany of indictable charges against Hillary, but decided, after putting on a judge robe as well, not to prosecute her. That same disgraceful James Comey, who had a 30-year career at the highest levels of the FBI and the DOJ, the Department of Justice, will not be prosecuted for his treasonous acts. Plus, the US government, under Attorney General Barr, did not charge him with stealing government documents and leaking them. Comey used government property to write confidential memos, which he took home, which he gave to a friend, his professor buddy, his leftist professor buddy, and then leaked to the media. This undermined the FBI because he was out to get President Trump. The FBI, which reports to the Department of Justice, isn't supposed to be political. Otherwise, there can't be any justice by definition. I think you would agree. And in a Hillary redux moment, while Comey was chastised for these violations by the U.S. Inspector General's report released just the other day, on August 28, 2019, he should not have gotten a pass on this from U.S. Attorney General Barr. As Mark Levin recently aptly wrote, we shouldn't allow the FBI director to leak and steal. Otherwise, we shouldn't even have an Inspector General investigation. Said differently, we shouldn't allow an FBI director to leak and steal with government approval, for this continues to make an utter mockery of the rule of law simply because those in the highest positions of power in government stand above the law, regardless of the horrendous crimes they commit, which, if only a tiny fraction of such crimes had been perpetrated by any normal citizen, would have had that citizen hauled away, indicted, charged, and locked up in jail for a decade or more. It's true. And there are examples, which I can't get into here for length's sake. In fact, this, what would happen to a normal citizen, is precisely what the lawless puke, Comey, warned about during the summer of 2016, when he looked into the camera and had the audacity to warn Americans not to engage in this type of behavior, namely the type of behavior that Hillary Clinton had engaged in, or else face the full force of the law. Talk about the pot calling the kettle black. My God. My bigger point is this. The West no longer has representative government, nor does it have the rule of law when it counts, when the high and mighty face justice, not. The shadow this casts on everything couldn't be more freedom and inalienable rights menacing, or valuation pummeling, at least over time, because it robs investors of confidence. Welcome to the era of banana republics. You don't have to search for them in Latin America anymore. They are beneath your feet if you're in the OECD world. Let me now take you through a hit parade of what I call insanity. Pardon my harping on this, but if our collective insanity was reflected in far beyond reversion to the mean bear market valuations, remember, we have manic depressive markets from boom to busts, from bubbles to incredible asset sales. But if all of the tough reality, our insanity in a wide sense, was reflected in valuations, it would be a purchasing opportunity. Because remember, valuations always go way beyond the mean. When they become depressive, you inevitably more than incorporate or discount the bad news. But we're at the opposite end of the spectrum, which is why this is so dangerous for capital at risk in bonds and stocks. A valuation opportunity would thus discount. A good valuation opportunity would discount or price in crappy productivity and crappy growth spawned by financial repression or sustained large central bank purchases of government bonds and the artificially low interest rates at the short end that they set with their zero interest rate policies or their negative interest rate policies, right? That's what financial repression is. It allows statism to flourish at the expense of the private sector and free market capitalism. Sustained financial repression, as we've had, underwrites public sector deficits, debt, expanding government, unprecedented global insolvency/default risks, and global debt-induced deflation risks, which will soon trigger even more global Frankenstein finance/fiat currency debasement by the Davos plutocrats and their bureaucratic pals, the real killers of free market capitalism and the smothering of wealth of nations trajectories. When I refer to juicy bear market valuations, I'm talking about valuation opportunities where investors can purchase so-called AAA government bonds with double-digit yields and stocks with PEs of 6 to 8 times recessionary earnings. And yes, Virginia, they haven't done away with recessions. Why 6 to 8 times recessionary earnings power or EPS? Because corrective, self-cleansing, bankruptcy-enabling, misallocation purging recessions have been artificially strangled by our central planners on heralded financial repression for so long that the coming hangover and the ensuing damage to real GDP growth, earnings power, and EPS growth will last longer than normal. We've dug ourselves a very deep hole. In fact, our hangover will likely last much longer than normal. That's why you have to focus on recessionary earnings power and what you pay for them. And when I say recessionary earnings power, I'm talking about 50% or more lower EPS than we have today. This whole unhappy circumstance is due to the global 10-year plus party of perversion. I'm using strong words, but I mean it. So please don't think I'm not making these comments without thinking. I really think it's a perversion. And I think we appear to be doubling down on it, be it politically, the rise of statism or bureaucratic tyranny, socially, we don't have just two sexes anymore. Economically, we've long been punishing the dense energy that makes our productivity, our profits, and our leveraged output possible, our way of life. And financially, central planners or statists have killed incentives to save, starving economies of the savings which they need to invest in new generations of products. When will confidence in Frankenstein finance shatter? How long did it take for the little boy to ask the emperor why he was standing there in his underwear, not in fine silk clothes? My point, it's not a question of if, only when. And that when, as I've often said, keeps getting closer. How's about possibly on Monday, next week, next month, or later this year? Better get your dime out of overvalued bonds and stocks, which you purchased at elevated prices while you still can. You know the story. Back to the overdue financial storm. Well, before I do that, let me say that the claims and assertions that I'm going to make will hopefully prove to be pretty self-explanatory. I'm going to drill down with some cases in point. I'm going to add some substance to my claims that our house of cards is looking for a confidence diminishing breeze. It doesn't need a storm or a hurricane. By the way, Hurricane Dorian is targeting Florida. I've been through 3 and don't need a 4th. And unfortunately, or fortunately rather, it looks like Southwest Florida will get off easy this time. But those weather predictions are apt to change. Well, let me get back to the overdue financial storm. Everything is hanging from a confidence thread, which is vastly enabled / sustained by our human tendency to sweep everything under the rug until we are forced to react, no matter how threatening or visible. Right, underwear-clad emperor? How about acting, being proactive instead of reacting, as in selling the bubble, selling overvalued bonds and overvalued stocks that you purchased at lofty levels, and any bubble real estate that you acquired relatively recently, and doing this while they are still overvalued, as in now. I know, I sound like a broken record, but for some things, it's better to be far too early than just a day late. Oh yes, and as you ponder my idea revisited, here's that laundry list of madness so that you can put some meat on those "it's a mad world" bones. In other words, mentally juxtapose the forthcoming list against priced beyond perfection valuations of bonds and stocks, and to a large degree still real estate. And this primarily in the OECD world, I might add. And as you do, remember that today's consensus is that there will be no recession There will be no government defaults or pension plan defaults, and there will be no unparalleled currency debasement, even as central banks ready themselves to crank their electronic printing presses into high gear while pursuing even more creditor punishing, capital and capitalism eviscerating negative interest rate policies, or NIRP. I mean, you can't make this stuff up. If anyone had told me about this mad world, the new normal, when I got my CFA way back in 1990, I would have been convinced that that person was mad, insane, in fact. Instead, that person would have been prescient. Who would have ever thought? Now, finally, that mad list as you think about value at risk. Number one, recall all sectors U.S. debt at all levels was up a whopping $3 trillion year over year to $72 trillion in 2018, which is 3 times faster, that $3 trillion, than nominal GDP growth over the same period, and amounted to a whopping 3.4 times US GDP. Number two, again, these are all these incredibly tough and menacing situations we find ourselves in, and yet bonds and stocks are priced above or beyond perfection in many instances. Number two, the U.S. fiscal deficit has already exceeded the full year figure for last year as spending continues to outpace revenue growth. The gap grew to $867 billion in the first 10 months of fiscal year 2019, which is up 27% from a year earlier over the same period, the Treasury Department said. And in fact, this deficit is wider than last year's aggregate fiscal shortfall of $779 billion, which was the largest federal deficit since 2012, last year. And do recall the federal government's cook the books accounting. Translation, true federal government deficits, that is, with off-balance sheet outlays on board in GAAP consolidation fashion, are already exceeding $1 trillion and could easily rise into the $2 to $3 trillion range or more as the current economic weakness worsens. For $1 trillion plus real deficit proof, just go to the U.S. Treasury's debt to the penny site and you'll see. Number three, S&P 500 GAAP EPS growth is slowing markedly, dipping below 5% for the first half of this year in year-over-year terms, as one-time tax reduction and repatriation goose buyback bonanzas are cycled while organic growth remains weak, balance sheets are very leveraged, and economic weakness spreads domestically and globally. Are we in the eye of an EPS wilting storm, otherwise known as a deep recession in the wings or happening? I think so. And once again, what a recession it promises to be. Number four, furthermore, and I've mentioned this before, I think that GE's, General Electric's, decades of financial engineering shock and awe, or a cocaine sniffing, ego stroking, wallet fattening, C-suite, M&A, and stock buyback focus / culture has been aped broadly throughout corporate America, thoroughly displacing a previously healthy, grinded out, brick by brick, organic growth culture, and with it the wellspring of a wealth of nations trajectory. when combined with the hubris of the decadently compensated C-suite, which has gotten fabulously rich off of corporate anorexia in the United States, GE is a poster boy for what ails corporate America, from very poor quality, even fabricated EPS growth, to decades of income smoothing, to outright, cook the books accounting to make it all fly. That is, to turbocharge the stock price and thus the C-suite's decadent options packages. Everything else be damned. Sound familiar, Mr. Trump? And by the way, I listened to years of GE quarterly results as a buy-side analyst, and they were led by Immelt and his top lieutenants. And I can tell you honestly that their results were a tangled web of impenetrable complexity and lacking transparency, which is precisely their M&A intention, or was their intention. You couldn't dig down to what was going on at the organic level. It was a cloud of dust. In my opinion, GE is just the biggest global titan name to fully implode in this cycle, for a lot of S&P 500 company chieftains learned their trade at GE or admired GE Stepford wives like EPS growth. If any of you are familiar with that movie, Stepford Wives, you'll know what I mean. Talk about a potential sea change in investor confidence in U.S. accounting integrity that might be in the offing. I think it is going to be in the offing. Imagine what kind of elevated risk premiums investors may start demanding as other corporate results dishonesty shoes drop, which, by extension, will exert significant pressures on PEs, which are currently at 21.5 times trailing 12-month GAAP earnings. Compressing PEs will yield lower stock prices and market caps prior to dialing in EPS erosion of likely 50% plus as economic weakness expands. It's going to be quite the stock revaluation story. Stocks could come down way beyond 50%. I think closer to 75%. Number 5, all the flies in the ointment. My list to juxtapose against price beyond perfection bonds and stocks. U.S. industrial production is on track for its third consecutive quarterly decline in Q3. This on top of downside revisions to Q1 and Q2 industrial production contractions. That is, for the first half of this year, U.S. industrial production contracted, but in actuality, it contracted more. And these after-the-fact releases are often just ignored, and I'll get to that point later on. Number 6, in a related fashion, narrower related to industrial production, narrower U.S. manufacturing, up only modestly over the past decade, even as the S&P has more than tripled, released a nominally negative Purchasing Managers Index, that PMI, this August of 49.9. That's the weakest reading since September 09, with new orders dropping the most in 10 years, as export sales tanked to the lowest level since August of 09. Not quite a manufacturing revival fueled through trade wars, Mr. Trump. Number 7. In fact, let us drill down to a supposed beneficiary of Trump's steep tariffs, and that would be U.S. Steel, whose stock is actually down 66% in a year as it lays off hundreds of workers. While tariffs have provided a price umbrella, Trump's current tariffs have provided for a price umbrella for American steel and aluminum makers. U.S. Steel's domestic customers, the manufacturers, have gotten kicked in the shins as their wares had to either reflect the punitive tariffs or they had to try to eat the costs, which most makers can't, either because their shareholders won't stand for it or because their margins are much too thin to carry it. And those outfits include major appliance makers, off-road vehicle makers, and even select makers of machine tools. Bottom line, you cannot enrich an industry by making its customers poorer. That's my point. And even near-term beneficiaries of tariff umbrellas, domestic beneficiaries, such as U.S. Steel, will decline with their customers as decades of politically motivated tariffs have already clearly shown beyond a shadow of a doubt. Trump administration, anybody home? Number 8, in a related fashion, the trade war keeps on heating up. The latest Trumpian decision, another tit-for-tat response, is to raise tariffs on $250 billion of Chinese imports to 30% on October 1st from 25% currently. And notwithstanding Trump's demagoguery on this, including about who pays for the tariffs, the Chinese are becoming more aggressive as Trump simultaneously withdraws, for the time being, U.S. tech export restrictions on 5G Chinese Huawei. Apparently, Trump has been bludgeoned by Silicon Valley and suddenly is unconcerned by technology theft. Moreover, it seems to me that the U.S. stock market bellwether, Chinese/Asian manufacturing-based Apple, yes, Apple, could see its profits walloped on the tariff side or on the less competitive price front, which would add insult to reduced Apple product portfolio competitiveness in an increasingly mature market, cell phones and portable computers. In short, it looks like Trump is bowing to Silicon Valley and to the almighty stock market. First and foremost, farmers and industry be damned. Hello, red states. And as said, a broad swath of industry, of U.S. industry, from white goods to vehicles to aluminum can producers with material domestic capacity are suffering under either increased raw materials or increased component costs or from decreased competitiveness or decreased profits associated with the Trump administration's destructive tariffs on steel, on aluminum, on the associated imported component parts, and more. And as I predicted, an unfolding output disaster with global ramifications precipitated by an economic illiterate Trump, advised by money-grubbing protectionist cronies such as Ross Navarro, are increasingly looking like a done deal. Too bad the ghost of Herbert Hoover couldn't warn the Trumpster by whispering in his ear and telling him that no one can micromanage global trade or win trade wars. Trade wars always end in economic disaster for all sides and often in shooting wars. And I thought Trump was about less, not more government. about less, not more bean-counting bureaucrats erecting more trade-based regulations and compliance complexity and cost. In this sense, it's hard to ignore Trump's boast about the $75 billion in additional taxes that the feds have collected from Americans, not from Chinese, since tariffs were raised and this whole ugly trade war saga got underway. Number 9, separately, but in a related and revisited manner, recall, if you would, that international trade today accounts for nearly 58% of global GDP, up from 36% 4 decades ago. Global trade volume keeps on weakening, and it is going negative both on a 3 months versus the preceding 3 months basis and on a year-over-year basis. So guess what that portends for national economies in today's globalized economy? Recessions. Let me show you this chart, attempt to bring this into view here. Bear with me 1 second. This is what I'm referring to. The top chart is the 3 month over 3 month. You see this decline and this long-term or longer-term contraction. And the bottom chart is the year-over-year, where you see a profound year-over-year weakening, extending, and then turning down even more so. So if this continues or gets worse, we've got a global recession to contend with. Ugly fact number 10. Contrary to the talking heads on TV and the often ridiculous, grossly misinformed pundits that tout that America is less dependent on imports on foreign trade than other nations are, America is in fact more dependent on imports as its massive and growing goods trade deficit of of 891 billion in 2018, up 10.4% year over year, clearly shows. And while U.S. imports constitute a smaller share of its GDP than that of many other nations' imports to GDP, America has long stopped making much of what is bought at the car dealer or at Amazon or at Home Depot or at Walmart. And without these imports, supply chains break down. Detroit shuts down. Amazon's business model implodes. And Walmart shelves start to look like store shelves in Venezuela. And while imports of goods and services may make up only 15.3% of US GDP, those same imports underpin a plethora of manufacturing activity. I've referenced that in the past. In a globally synchronized, parts-dependent world, that you can't produce anything without having global supply chains. It isn't just that the imports underpin a plethora of manufacturing activity. Services activity, which depends upon being able to sell goods either wholly or largely made or partly made with foreign parts. And it, at the end of the day, also determines consumer purchases, the Walmart example. Moreover, US GDP is bloated by ever more fluff. That is, goods and services that aren't globally competitive, much less needed, from gargantuan SUVs that hardly fit into outsized American garages to absolutely unrivaled money spent per capita in the sleazy litigation arena, which practices legal extortion or shakedowns for the benefit of the few. That isn't the only thing that makes US GDP not comparable. It's also the fact that the U.S. federal bureaucrats collect over $2 trillion per year for regulatory compliance. In the United States, GDP generating stuff such as incredibly expensive title insurance, this large service sector, where the biggest risk is that Indians take the land back, is absolutely uncompetitive and unnecessary in the rest of the world. And outsized 6 to 7% real estate commissions on flipping real estate with nearly the same frequency as Europeans change vacation destinations are also 2 to 3 to 4 times levels in other countries, but they puff up GDP. That's the point. Fluff. By the way, staying on topic, the Chinese central planners / bean counters, not exactly honest people, I'll admit, doing the bidding of a communist party, yet not too different, I would also argue, from our U.S. statist bureaucrats who regularly revise down in very material terms minor stuff such as real GDP growth and job growth while understating inflation with all kinds of stunts. Those Chinese statisticians, the Chinese brothers of their American equals, estimate that a globally conformed tally of US GDP would yield a US GDP of between 5 and 10 trillion dollars, not 21 trillion. My bigger point is this. America is the most dependent of all nations on imports to sustain output and simultaneously the most dependent on overseas financing to pay for all the stuff we buy and can no longer make, or else we couldn't sell either. Services would take a hit. Call it a dual dependency. It's hardly a Daniel Boone kind of rugged self-dependency, is it? So why does Trump, his cronies, and many US pundits insist that China is the more vulnerable nation? How does one spell ass backwards? Number 11. Meanwhile, and confirming my coming unglued list so far, US freight shipments suffered the steepest drop since the financial crisis in July, the eighth month of year-over-year declines, and it dropped by 6.5% year-over-year. U.S. freight shipments dropped by 6.5% year-over-year, which is quite the contrast to the 13.5% year-over-year growth in early 2018. This according to the Cass Freight Index. Let me see if I can bring that onto the camera here. Here we go. There's that 13.5% high with expectations of the Trump economy going through the roof. The reality has since occurred. We're down to 6.5%. It's a pretty important barometer of the good side of the U.S. economy. And as such, is it any surprise that retail sales are contracting? Again, on top of downside revisions, U.S. statisticians, or that construction spending fell into an annual decline for the first time since the Great Recession, tremendously low mortgage rates notwithstanding. Item number 10, the bad and the ugly. Coming full circle to my opening remarks, when combining government and corporate debt, there is now about 17 trillion in negative yielding debt in the world. Hey, this is it's insane. Talk about bubbles. Investors purchase negative nominal yield bonds featuring even worse negative real yields as both monetary debasement and insolvency risks continue to spread like a bad and chronic skin rash. Bottom line, creditor haircuts, creditor scalps, or piecemeal loss of creditor capital to inflation, which will suddenly accelerate once inflation fears are stoked, resulting in a quickly metastasizing purchasing power default. So inflation and insolvency are again tied at the hip. It's one or the other. They both end up in the same place. Investors lose their capital and their purchasing power. What am I referring to here when I talk about this whole thing? I'm referring inevitably to the pricking, the overdue pricking of the bond and stock bubbles, or a shift out of paper assets into real assets by investors, speculators, businesses, and consumers, right? And that is what's going to ignite a possibly unparalleled stagflation, make the 70s look like a warm-up. That's what I personally believe, given where we're at. Let me give you some supporting comments that I'd like to draw to your attention as regards this. How is this shift? How is this shifting out of paper assets into real assets going to work to fuel ultimately hyperinflation? From debt-supported corporate stock buybacks of recent years and corporations awaiting lower raw materials and component prices, we're going to go to distressed corporations having to reissue stock at a much lower share price and having to rebuild business inventory prior to or accompanying rising raw material and component prices. From consumers waiting for lower prices to purchasing as goods get more expensive. From dollar strength to a dollar devaluation as the world unloads excess greenbacks from reduced US dollar trade, exporting inflation back to America, which will spike both the US money multiplier and US monetary velocity, triggering explosive money supply growth. Globally, with a monetary base expansion of some 18 trillion over 10 years, with negative interest rates, and with even more outrageous central bank balance sheet expansion in the offing, the demise of counterfeit currencies, the yen, the dollar, the pound, the euro, the Swiss franc, the demise of counterfeit currencies will only be hastened, and this will stoke horrendous inflation in its wake as people shift from financial assets into real assets, in the process extending the monetary base explosion to the money supply, and giving us the classic definition of inflation, namely too much currency chasing too few services and goods. At the end of the day, inflation is a monetary phenomenon, period. On the NERP and negative bond yields fronts, let me reiterate that this is tantamount to doubling down on disincentives to save, while at the same time incentivizing financial engineering / stock buybacks / debt encumbrance over instead focusing on capital spending, CapEx, productivity, and organic growth. That's what NERP and negative bond yields do. And I haven't mentioned what we all know, namely that banks who make money borrowing cheaply at the short end and lending it more dearly at the long end no longer have much of a spread. In some cases, it's all gone, or worse. Add this to the fact that the ECB with NERP is charging commercial banks to hold cash reserves. Is it any wonder that European banks' profit margins are coming under even greater duress? which is also resulting in decreased lending, the opposite of what NERP was supposed to achieve, negative interest rate policies. Thus, we'll need here's the ironic thing, we're going to need even more money printing than ever before, thanks to negative interest rate policies. Once central banks lose their absolutely unearned credibility, possibly triggered by a rapidly declining global economy, accompanied initially by debt-induced deflation, they will be forced into hyper balance sheet expansion, accompanied by even more stout debt creation, which will ignite a total loss of confidence in fiat currencies, triggering an exodus out of bonds in fiat currencies and stocks and into scarce assets and into consumer goods. Finally, point 13, this flattening of the yield curve, or the much touted yield inversion that so many are focused on, fixated on, is the wrong place to look, in my view. I think people should be focused on all the growth and productivity eviscerating realities instead, including the unparalleled debt, gaping public sector deficits, and the cost of aging societies, whether they are on display in the US, in the UK, in Japan, in Italy, in Spain, or elsewhere. Moreover, investors should instead focus on the associated failing productivity and on the dwindling affordable dense energy, fossil fuels, upon which leveraged output, profits, and our way of life is based. These are much, much more important indicators of where we're going and why than an inverted yield curve, a lot of which is the result of misguided, algo-based, mindless flight into supposedly safe assets, so-called investment-grade government bonds, which are, once again, for the most part, grotesquely overpriced junk bonds without real yields, usually tethered to a printing press. When our coming stagflationary future arrives, and I don't think it'll take long, it will be the progeny of our long-standing, toxic, statist public policy stew, which has so eviscerated free market capitalism and freedom. Investors will flee bonds and most stocks, much like they did in the 70s into the early 80s, when 10 and 30-year Treasury yields topped out at over 15% in 1981, and stock PEs fell into a prolonged single-digit realm that accounted for the bigger part of a decade or more. Secularly dwindling economic growth, accompanied by rising inflation, thanks to the progeny of unparalleled financial repression, namely statism, cronyism, redistributionism, and massive third world amnesty, that is our future, sadly. As inflation transitions from financial assets to the real economy, as described, and as the central banks of the world double down on counterfeit currency destruction with even more outrageous QE and even more pronounced ZIRP, zero interest rate policies, and NERP, negative interest rate policies, the misplaced and misguided confidence in the unsustainable status quo will evaporate virtually overnight. This will be when the yield curve steepens abruptly and sustainably to reflect the obvious. Your fiat currency bonds are worth a fraction of what you paid, and no one can do anything about it. Thus, don't get too sucked up by negative yield curve stories. Stay one step ahead of the myopic focus of investors blindly rushing to false safety assets, to false safe harbor assets, like bonds, much like cows following frantic bulls over a cliff. Don't follow them over the cliff. Be a bear. Position yourselves to take advantage of what will quickly reprice down, namely bonds and stocks alike, while setting a fire under scarce real assets and, of course, real money, physical gold and silvers, as investors start a massive reallocation. Let me close out my Mad Hatter list with a bookend to 10-year treasuries yielding 1.5% and some 17 trillion in negative yielding debt globally, with an absolutely hilarious IPO filing earlier this month. A filing which is supposed to go public in September. That company is WeWork. Now, WeWork featured 1.8 billion in revenue and 1.9 billion in losses in 18. It lost a stunning 905 million in the first half of this year and 4.3 billion over the past 3.5 years, slightly over 4.3 billion in the last 3.5 years. The company is targeting, get this, 3 trillion, yes, trillion with a T, in revenues. If this puppy goes public, and on the heels of the Uber IPO debacle and others, it will simply prove that both stock and bond investors have lost their valuation minds, which others can capitalize on. This is Dan Kurz, DK Analytics. It's August 31st, 2019. I'm back in Bonita Springs, Florida. I hope you found my food for portfolio thought of use. Is this exciting year blowing by faster than ever or what? And I think it's about to get even more exciting, or should I say tumultuous. I see it's getting dark. I apologize, but I'll do even better. I'll say bye-bye.